Welcome to MBMC, Millennial Boomer Money Concepts. We're going to go into, or he's going to go into rather, the how to actually look at and pick a stock, because that, I would say that's equally, if not more important than the actual stock, right?
It is. You teach a person how to fish rather than give them the fish.
Yeah, but then they get food poisoning.
Well, it depends where you fish.
Yeah, so anyway, so welcome back. If it's your first, if you're coming back, or if you're new, this is Millennial Boomer Money Concepts, where a millennial, which is me, and a boomer, which is my dad, go over everything we agree on and disagree on, discuss on money concepts, investing, side hustles, all that different stuff, with the goal to help give you clarity and confidence when it comes to money and investing and things of that nature. So today, using the Standard & Poor's Index Fund, Lion, Tigers, and ETFs. So my dad, take it away.
All right. Well, probably this is the most broadly invested in index because 401ks and brokerage houses and even investments like mutual funds put money into this investment, Standard & Poor's Index Fund. There's more than one. The most popular one on the stock exchange is called SPY, is the ticker, but it's basically the Standard & Poor's Index Fund. So what I want to do is show you a little bit what that means. So what the Standard & Poor's Industrial Index does, it takes the top 500 companies in the country, and by market cap, it invests money in it. So if you had like $1 billion to invest, it figures out how much market cap the top 500 companies make, and then they prorate by market capitalization what people get.
Dad, could you go into what market capitalization is?
Yeah, it's a great idea. Like, let's look at NVIDIA. That's a AI company that does chips and things. The current stock price is $173. And if there's 1 million shares of that, there's more than that, you do the 1 million times the price, and that's the market capitalization. So if the stock goes up $1 and there's this many shares, then the market cap goes up, and similarly if it goes down, it will go down that much.
So if it's like when people say it's $1 billion company, that's the stock price times shares. That's what it's worth. Okay.
If you had that much, assuming you could buy all the shares at that price, you could buy the company for that many billions of dollars. In this case, probably trillions for these big companies.
So it's just another way of saying what a company is worth on the market.
Right.
Okay.
So if you look at the top 12 companies inside the Standard & Poor's, and this is as of August 29th, so it's today as we're recording, NVIDIA is 7.3% of the S&P 500. Microsoft is the next highest by market cap. That's 6.5% by market cap. Apple, almost 6%. Amazon, 4%, and so forth. Down to Walmart is 1.33%. Doesn't sound like much, but with 500 companies, the average company would have 0.2% if they were all equal. So these are monsters in the industry. Now, the fascinating thing to me is if you look at all these together, I have this cumulative, like Microsoft and NVIDIA together represent 13%. If I take the top 10, which includes Berkshire Hathaway, you got 37%. The top 12, including Walmart, is 40% of the whole market capitalization of the Standard & Poor's. So 40% is the top 12 companies. The next 488 to complete the Standard & Poor's 500 is 60%. So there's an awful heavy weighting of the top 12 companies, and even the top 5 would be a quarter of the value.
What is Google's look like is listed twice? Alphabet Incorporated.
They split into two kinds of shares. So the market cap of Google together would be 4.4, like 4.5% of these two. They track similarly, and we'll talk about them in a little more detail. And typically, everything in your 401k that goes into the Standard & Poor's fund is invested this way. So it's a big deal. And if you invest a lot more money, you being the whole people that invested in the industry, they take your money and divide it to these companies. So NVIDIA would get most of the money. Well, not most, but get 7%. They would get maybe 6 times more than Walmart would get, and probably 100 times more than the small companies would get in the Standard & Poor's. So that's the, understand that, Dan?
Yeah, but I'm curious, like when I grew up, like is the Dow dead? Because I missed the funeral for that, because it seems like there used to be the Dow index, now S&P. Is the Dow still around, or like why is S&P, like what happened with the Dow versus like talking about the S&P?
Good question. The Dow Jones has been around for probably since the 1800s, and there was only a few companies, so they had the Dow Jones Industrials, which is the 30 biggest companies, and they picked what they were. And they've changed over the years, obviously, and they keep constantly take some out and add some, but it's the top 30, and that worked great until about, I think, in the late 50s, 1956 or 57, with the advent of computers. Someone said, hey, we can take the top 500 companies, and the Standard & Poor's index was created, and they just put the prices in. It'd be too hard to do by hand, but with computers, you put the market closing and you have a new index. So it took the top 500 companies, and they're weighted by market cap. I don't want to get into the Dow Jones is got a weird weighting. I don't want to get into what that is, but it's crazy, the different weighting factors. So this at least makes, to me, more sense. So the Dow's not dead, but this is a more broad index, the S&P 500.
So what's the whole thing with the, like you have in the columns, like G, like the P to E, the normal, the growth rate, like what are we doing with that?
Well, let's look at these. Now what I did then, I said, okay, here's the top companies. And I'd say, would I want to buy the Standard & Poor's index right now with money that I have? So from the last video, the price to earnings ratio in aggregate is how a company is valued long term. So if a company earns $1 in earnings, Warren Buffett says you should pay no more than $15 for that. Another way of saying it, if it earned $1, in 15 years, you've earned back your investment if you got all those earnings in cash. So, and he doesn't want to pay more than that except in special situations. So, if you look at NVIDIA, you can see right here the price to earnings ratio right now is 46 times earnings. Now, the reason it's so high is because of the growth rate. People are thinking that's a stock on the come. There's a lot of AI fueling this company. In fact, the growth rate for the last 10 years has been 58%. And the other school of thought, besides the Buffett, the 15 times earnings, says, well, you can pay up to the growth rate of the company. So if it's growing at 58% per year, you could have a 58 times earnings because you're figuring in at that growth rate in 2 to 3 years, it's going to capture, your PD is going to be a lot lower, at least in today's dollars. Now, so the normal PE is 46, the growth rate is 58, and that's why NVIDIA has grown so much and why it's the top market cap in the index right now. Microsoft, it's a more stable company, it's been around a lot longer. The price to earnings ratio right now is 36.6. It's in red. We'll talk about that later. The normal PE over the last 10 years is 31. The growth rate is 18. So Warren Buffett would only pay 18 times earnings, which is almost half what the market's valuing it right now. So Microsoft, that's why it's in red. That's a pretty high P/E by growth rate and by the Buffett metrics.
So the target price would be roughly $250 or so?
Yeah, if it goes back to the growth rate, you'd lose a lot of money. Now, the theory is it's going to grow, but I think that's, of the two, it looks like I'd rather go with the higher growth NVIDIA at the 46 price to earnings than Microsoft at 18. The truth is I'd want to probably do neither of them, but those are the first two. Apple right now is 31. The normal PE is 24. The growth rate is 14. So Buffett would pay 15 times earnings. This is probably way overvalued by Buffett's indication. Now, Buffett's not God. There's no guarantee that these are right. Those are just rules of thumb. But I'd be weary at these metrics of buying those companies.
Well, he has enough money to play God.
Yeah. Okay. Amazon. Here's the first one that might be reasonably priced. The growth rate for the last 10 years is 44%. Normal PE is 67. It's only at 36 times earnings right now. So I didn't put that in red because you're buying it at lower than the growth rate. Meta, which again I don't like the company, but I would never buy that. You're paying a premium for that one. Broadcom is another chip company like Nvidia. 48 tracks to the 46, but the growth rate's only 20 on that. So Google is one of the lowest PEs here. We got 22 times earnings. Normal P is 25, so might be a reasonable deal. And by the way, the last column is yield. None of these companies pay much of a dividend. So there's a 0.2%, which is nothing. The highest one is JP Morgan, and Walmart pays a 1% per year dividend. JP Morgan is almost 2%. The rest of these pay nothing or fractions of a share. Look at Tesla. The price to earning ratio is 180, and the growth rate is 23. The quote normal P is 134, but that's probably way overvalued at these numbers. So these top 12 companies, I have 1, 2, 3, 4, 5, 7 of these I have in red that I think are overvalued. I wouldn't buy the individual stock. Some are fairly valued, maybe Nvidia. None of them are a bargain to my way of thinking. So if you take the Standard & Poor's in aggregate...
Wait, what would be a bargain in your mind?
Anything under 15 for the current price to earnings ratio.
Would it Amazon be a little bit of a bargain?
It would. Well, here's the problem with the high PE, the 44%. I worked for a company that was $5 million in sales. If you grow 50% in 1 year, you're from 5 million to 7.5. To get the same growth rate the next year is very difficult. I mean, you'd have to make maybe 20% more to keep going. So if they miss this growth rate 1 year, this thing could plummet. So even though it's fairly valued by the price to earning equals the growth rate, it's difficult to sustain these numbers. And they're all high except for JP Morgan, which is a whole different industry. It's financial. It really shouldn't be compared with the rest of these companies. And then you have a brick and mortar like Walmart. You're comparing that with the high tech companies. So there's a lot. It's a mixed bag, and that's why you buy the S&P. You want to have everything kind of even out. You don't want to put all your money in Nvidia or all your money in Apple.
What about GameStop?
Now the thing is, it's real sexy to put your money in Nvidia because you might have grown $1,000 to $10,000, and literally, if you had it for 5 years, it's a huge growth rate, and so people are seduced into buying. I want to get that again, but it's, as I said before, once you've got the growth, it's hard to continue it. To get a 60% growth rate for a long time, good luck. They've done it, but what's the chance of continuing doing that at the numbers they're having now at the market capitalization? How do you continue to do that? And I think it's too hard. In aggregate, the Standard & Poor's in aggregate, if you took all the companies,
Scroll down a little bit.
It's got a price of, today was 64.54 is the price of the Standard & Poor's index. It's got 100% of the companies. And if you took the earnings of all those divided by the price, it's at 24 times earnings. The growth rate of the whole Standard & Poor's 500 is only 10%. So Warren Buffett says, I would pay 15 times earnings for that, not 24. The market says in the last 10 years, I would pay 21. That's what they paid for it. But it's higher than the average for the last 10 years right now, which is why it's also in red.
Does the dividend yield factor into adjusting what you would pay for the PD? So like if the yield right now, if the yield was, let's say 10%, 10 times, would that affect how you look at whether or not the P to E was a good ratio or a good deal or not?
Yes, it affects it in a couple of ways that we'll go into later.
Okay.
So now basically, the higher the dividend, if the stock goes down, the dividends can go down, but they don't go down that often. So this is kind of if the market crashes, at least you're still getting your dividend. So there's an intrinsic value of what these are worth, and I like dividend stocks. So actually, except for JP Morgan, none of these are really dividend stocks. And my average of my portfolio, I have like 4.5% to 5% is what I get average. So all of these are well below what I'm getting from my portfolio. Now, granted, I don't know the growth rates these have, so I'm sacrificing future growth for a little bit of growth and then a yield, which I then reinvest in the stocks. So the whole S&P 500, I think, is overvalued. Were it to go back to the 10-year average price to earnings of 21, it would have to drop from 6,400 to 5,500, which is a 14% drop. And then it would be on the average for the last 10 years. If Warren Buffett were to buy it, he'd want 15 price to earnings because it's only got a 10% growth rate. It would have to drop to $3,900 or almost 40% drop from today's value. I'm not saying it's going to drop, but to get back to the normal PE, it would have to drop 14%. To get back to where Buffett would buy it, it would have to drop almost 40%.
Now, when things revert back to the mean, it may not drop, but it makes logical sense that the market is going to go down eventually to go back to the 10-year average, correct?
Well, either that has to happen, or the earnings push it up so high that's either the stock drops or the earnings rise. That you have to get the metric back in balance one way or the other. If it doesn't with the earnings rising, you can keep the same price, which is what they're gambling on in these big stocks. Because the price to earnings ratio is here for like NVIDIA, 47, but it's going to drop as the earnings go, and if they grow by 50%, that's kind of like the treadmill that NVIDIA's on. So as long as they keep with these huge, amazing earnings forecasts, then that's a great stock to buy, and it has been great. I'm not arguing that any of these stocks weren't a good investment. I just think today I wouldn't want to have too much money in these things. Now the problem is in 401ks you're limited in choices. You can't buy like Broadcom by itself. You got to buy the funds that they allow you to buy, and this is a common one, is the Standard & Poor's. Just one other thing on the S&P. This is a graphical representation. These are the top 12 companies, and that's the 40% by market share. So this whole pie is 100% of the Standard & Poor's market capitalization. This is NVIDIA. The top 12 companies handle 40% of the growth. The 488 companies have 60%. So, the reason it's done well, these companies have done phenomenally in the last 3 years. Hence, the Standard & Poor's is at all-time highs right now. Any questions there, Dan, before I move on?
One, but we don't have to get into it right now, but I'm wondering, like, if you scroll back up, Dad. Okay, so is there a fund that uses the Buffett P/E logic and only invests in the ones in the S&P that actually fit that criteria? So, like, with that logic, like, it would buy NVIDIA, Amazon, all the ones in black. Are there ones that exclude the PD is too high? Do you understand what I'm asking?
I'm understanding that. But basically, there are funds that do those things, and they say what they're talking about. In fact, you had one called JEPI, and let's talk about that. That's now the Standard & Poor's, the expense ratio is like 0.2%. In other words, if you have $1,000 of market cap, they'll charge $2 for the management of it, which is almost nothing. And the reason they can do that is that it's just mechanical. When you put money in, it buys it in these percentages. If you take money out, it subtracts from these percentages. What you're talking about is a more managed fund, and JEPI is a managed fund. So let's take a look at that one. And
well, actually, what are the three main options to invest? Can you explain what an ETF is before we go into like JEPI, VTI, and SPY?
Okay, ETF is electronically traded fund. ETF. And there's not a one size fits all. There are literally thousands of these. Some are huge, like SPY is the one that invests in the Standard & Poor's, one of them. In fact, in your 401k, if you have a Standard & Poor's option, it's not the SPY, it'll be that company's, like Fidelity or Vanguard, whoever owns the or manages the 401k has its own fund. They might buy it out from Vanguard or somebody, but there's tons of them. And you got to look at the prospectus to find out what they do. Now, JEPI, for instance, it tells you, in fact, I got this somewhere, it'll tell you.
The PDF, yeah.
Here we go. Here's JEPI, and it's a equity premium income ETF. So let's look at what it does. Designed to provide current income while maintaining prospects for capital appreciation. So it wants growth, but it wants current income, which is basically dividends. And in this case, it's also, they use something called covered calls, which I'm not going to go into, but it's a way to use options to turbocharge your income. Morningstar rates all these, a lot of these ETFs. It gives it 3 stars, which is average. 5 stars would be best, 1 would be worst. So they say this is average. And if you look at what this thing's done, it was worth $10 a share in 2019, say, and it's gone mostly up.
That's where I bought it.
Yeah, Dan bought it in here somewhere, which is good.
A massive $100 investment.
You
Woo!
should have bought more. It's at probably 12 or 13. Currently, it looks like it's selling at about $17, $18 a share. And it's pretty much, it was a little higher here, but it's done very well. Now, if you look at the, there should have a place where it talks about the management fees. I bet it's about 0.3%. So it's a lot more than the Standard & Poor's Index. But they search for companies, there you go, the expense ratio. So it's 1/3%. Still not bad. But that's 18 times higher than the Standard & Poor's. But Standard & Poor's is just a monkey. They just buy the index. You put money in here, they actually search the stock market to find companies that are undervalued, for instance. And here's their approach and stuff. Here's the people that are managing it. Some have 38 years experience. Judy's got 10. So this is a thumbnail sketch of one of those, and it's done very well. I have no way to fault that at all. So that's one fund that's available, and the more managed it is, the higher the expenses. And Warren Buffett does not like high expenses. 1/3 is not bad. It'd be better to get less is better. But some of these go have 1 or 2% management fees on these things. You got to be careful.
But if their performance is a lot better, then they justify their fees, correct?
Exactly. I mean, since here you bought it at 10, you've given up. Well, that's 4 years. You've given up 1 1/3% in fees, but it's gone up. What's that? It's gone up 80%. 80%. That's a good trade-off there. So I'm not saying fees are bad, but you want to see how much it is and kind of.
Wait, would it be? But isn't that per year? So it'd be 1.2. Oh yeah, you're right.
Yeah. It'd be that every year you're paying 30. So if you had $100 in here, $350 of that's going. No, $100. 35 cents of $100 is going to that every year. That's not too much for $100. Now the Standard & Poor's 2 cents is going to the management. So 35 cents isn't bad, especially given it's made money. What hurts is if it goes down. You still pay the expense fees and you're losing money.
But with this one, the covered calls actually help with that, right?
It can. We're not going into that today, but yeah, that's part of how they made their money is covered calls. And anything with options, it turbocharges gains, but it also turbocharges losses. In this environment with a growing market, it's a winner. It can work. It's a double-edged sword. It can go the other way.
So, the logic is when it goes up, and when it goes down, they can still make money because of the option stuff.
Yes.
Okay.
So and you got to look at each one you buy. You want to get a thumbnail sketch of what it is, and then figure out if you want to buy it or not.
All right. So the spreadsheet was the SPY, right?
Yes.
Okay.
Now let's look at what Fast Graphs has
Just
here.
click right there.
And here's Fast Graph. Again, this is a tool that I have a subscription to, and if you're going to buy individual stocks, it's well worth the money. I think it costs like $500 a year.
Wasn't it a father and a son combo as well, Dad?
Yeah, the dad, he's called himself Mr. Valuation. A guy named Chuck Carnival. I think he's older than I am even, but he's been a value investor, and this is his technique. His son took his techniques and put it to a graphical form, and there's tons of data in this. And I'm not going to get in. I talked about it in depth with the Rexford video we did last month. But here's the SPY, the SP Standard & Poor's. So this goes back 20 years of performance, and the orange line that I'm looking at here, that's the 15% fair value ratio that Warren Buffett would buy it at. The blue line is where the market values it. Sometimes lower, sometimes higher. That's what it thinks it should be at. The black line is the price of the stock. So notice, if I'm looking at this is for 20 years, Warren Buffett would have bought it in 2008. That was the great financial crisis. And by the way, then the earnings went up. Here he could have got it for less than 15 times earnings. Here's 12 times earnings. This was a great time to buy it. And here it's right at the fair value. Then it started going up, and it was above the 15 for years. And then it dropped down to the 15 again briefly in 2018, again in 2019 or 2020.
That's COVID, right?
During COVID. Since then, it shot up, went down a little bit, and now it's in what I would call very frothy territory. It's up here. And it's like my chart indicated, the Excel spreadsheet, this is way over what the market has valued it at over history, and well over where Buffett would pay for it. Even with increasing earnings, which are these, it's expected to grow 15% this year, 14% in the next year, 10% the next year, which are very good growth rate. That gets it to here. But the price of the stock is already up here. So if it went from here to here, you're losing 20% of your money, or 9% annualized.
So, Dad, is this also, because we talked about it in episode 1, was emotion? You need to not be emotional, because when it makes sense to buy with logic and sound principles, that's when people are scared. And when it doesn't make sense to buy, everyone's thinking the market is never going to go down, and you should buy in, and stupid money takes over. Correct?
And that's the problem, because let's say in here, it was valued at 22 times earnings. It should have been 15. People look at this curve. Wow, they buy high because it's gone up, and then if it goes down, like from here to say here, you lost 21% of your money. If you bought here, sold it a year later, you lose 20%. People don't want to buy when it's going down, but that's when it's a bargain. People didn't want to buy in here. The market's not doing anything. When it becomes popular, and by the way, for the Standard & Poor's, it's the underlying companies. So the NVIDIAs, the Microsofts, the Googles, people say they can't go down, therefore I'm going to keep buying. And they might be wanting to diversify into something else up here. And it might, by the way, just because it's gone up here, it could very well at $800. It could go up. There's no guarantee it's going to go down. Just because I say I think it's overvalued, the market says otherwise. It says it can keep going, and it might. But I don't want to take the risk of even if it goes to the fair market value and the earnings go up by that amount of money. You're making 1.75% from here to here, plus a little bit of dividends. So that's not you could do better in the bank. That's assuming these earnings trends are made and it goes back to the normal PE. but it could stay at this upper P and go up to $1,000 a share.
So maybe another topic is, when ETFs are high, maybe it's like some other options to look at to invest your money when things are overvalued. We don't have to go into that now, but I'm gonna write that down.
And that's why what I do, I look at each company individually when I make a decision to buy. I don't look at, and I wouldn't buy this company. Let's look at Tesla. Just to make a quick thing here. Okay, here's Tesla as a company. Notice here's the earnings, and there were no earnings here. It lost money. Huge increases in 2022, and the price of the stock's way up here, but the fair value from Buffett is down here. This can get to be a huge loss. But people look at, wow, if I bought it here and sold it here, I'm making 52% annually. I've tripled my money if I did that. I want fundamentals. I want something where the earnings are going to go up, and eventually the stock price will revert to the mean, and I'll recoup the money. Now, the problem with Tesla, reverting to the mean means going down, unless the earnings are huge. And they are projected 51% growth, 26, 36%. Those are great, but the stock is so high priced, you can never buy that.
What's the scorecard?
Scorecard.
Oh, to right. No, scroll down. The ones.
Analyst scorecard. This is based on these projections. The 51%. This is analysts that predict this. In the 1 year forecast, which would be this one. And by the way, they're expected to lose 31%. They're going from 2.4 earnings per share to 1.67, and then back up. But anyway, they beat projections for the 1 year 30% of the time. They missed 63%, which means you can't trust these estimates. For the 2 year forecast, which are out where these guys are, they beat it 18%, they hit it 18%, and they missed 63% again. So I don't put a lot of faith into these estimates out, in fact, any of these estimates.
Good batting average, not really that
now
good.
let's look at one that I do have, and then we'll finish this off. And this is basically a real estate investment trust. They invest in multifamily homes across the country. So it's a very stable industry. The growth rate is only 3%, way lower than the others, but look at the consistency. Look at the earning. This line is, I look more at the earnings. They can go down, and during the great financial crisis, the earnings went down, but after that, a little bit of increase, not a whole lot, went down a little bit in 2020 in COVID, and they expect to grow 3 or 6%. Nothing great, but the reason I like this stock is because it was way undervalued here. It never hits the 15. It did briefly here. Because it's such a safe industry, people always need a place to live. The market gives it a normal ratio of 20 times earnings. Buffett will pay 15. It's got an A+ credit rating, so they manage their money well. They've only got 33% debt to capital. So it's a very strong financial company, and I've bought this company in my portfolio because if it does go down, let's say it goes down, if it goes down to here, which is basically where Buffett would buy it, I'm only losing 6%.
Because the dividend's so high.
Well, I'm losing 13% in growth overall, but I earn back some of that in dividends. The dividend is almost 4%, 3.8% dividend. And by the way, I'm going to get that even if the price goes down. That's to me, that boosted up. And I don't expect it to get down to 15 because it doesn't do it very often. And it should get back to where the market values it, which has been a higher, looking in here, it was closely selling for where the market valued it for years until it got frothy up here. It went up too high, went down below where the market valued above the 15. Then it got way overvalued up here. And that was not the time to buy it. But again, people look at the growth. Gee, it's gone way up. I need to buy it.
So COVID happened in 20, right?
In 20, that was this drop.
And then the real, like the office people started freaking out about office space around then, or about the same
Why
time?
this went down? Well, let's look. Why it went down to me because it was way over. It was 35 times earnings. It was just too expensive. Still a good look at the earnings. The earnings went up during this period, but the stock said, "Hey, it's not going to grow like an Nvidia. It's not going to grow 20%. I want to sell this and buy Tesla, or sell this and buy whatever." So it's supply and demand. It went way down to here, and that's the time to have bought it. In fact, anywhere in here. I bought it. I think I can show you with my portfolio. If I look at me, I'll show you. This is me because if I look at my companies, it shows you where I bought them. Now notice here, green dots are purchases, and red dots would be sales.
Got it.
So you can tell I haven't sold it. Let's get a closer view to get an idea. This is only 10 years. So I bought it in here. I bought here. I bought some of these just reinvesting dividends, but I'm still buying. I bought another 100 shares August 5th because I liked the fact it was down here. So I love this stock.
Got it. Okay, so then we have JEPI, we have SPI, and then do we have time to go into VTI, or you want to leave it at that?
VTI. Okay.
Or we just do a high level.
I think well, VTI very quickly. This is the Vanguard total market stock. So Dow Jones has 30 stocks. Standard & Poor's has 500 stocks. This has all the stocks in the stock market. Again, the expense ratio is 0.03, very low because they just put it based on market cap of all these companies. And I don't know if it's got, there's performance. I'd like to see a graph. I don't know if the performance is going to have a graph. It may not.
There you
go. It says here, look at the mark based on the price. The 10-year growth rate is 13%, 5 years 15, 3 years 16, 15. So it's averaging 15, which is a phenomenal growth for the last 3 years. A little less for 10, but still great. Year to date, it's right on target. We're over halfway through the year. It's 8%. It's projected to keep going. So, but it's not surprising because all the stocks have gone up. But I'm thinking with that market cap, I want to buy companies like Camden. It's got almost 4% dividend. The PE is almost 19, which is higher than Buffett would say, but the industry is so stable. I mean, long term, it's a winner. I'm going to keep this thing probably for 10 years. So that's how I invest. I don't look at the latest, greatest thing. I look at stable companies, consistent growth, and I'll buy them and never look back. I could not look at the stock for 5 years and I'd be okay because I don't care about dips. I just know in 5 years, people are still going to need to have housing. This is a well-managed company. It's got low debt, and it's going to be a winner. It won't break the bank like Nvidia, where it's not going to grow to 3, 4, 5 times its price, but it's going to be a consistent probably 10%. 5% in growth, 4% in dividends. It'll go back to the mean. So I expect to get 10% a year from the stock. That's all I'm looking for.
So then to recap on it, when you're looking at whether or not to invest in a company and stuff like that, you look at the P to E first, the growth rate, the yield, and then also the sector, correct?
Yeah, the sectors. You want to make sure it's a good sector.
Got
Very
it.
good.
So P to E 15 or below the growth rate if it's above 15 on that. And awesome. So thanks for joining on it. I know it was a very in-depth, but we want teach a man to fish type of thing, so you can take this knowledge, be more confident. And if you have any questions, feel free to hop in our MBMC money community on school, where we have discussions in there more in depth, answer specific questions. And again, we're not financial financial planners or whatever, the education on it, not promising good results. So feel free to join us there as well if you're seeing this on YouTube.
And can they send you an email too?
Yeah, you can. If you're part of the newsletter community, you can reply back to the email on that. I'm still getting the actual email address set up, so just reply back, join the newsletter, reply there, or join the $5 a month community on School. Until then, I don't know what we're going to do next time, but it will come up with something interesting. So feel free to let us know if you liked this, hated it, and why did you hate it, or that, and also let us know what other type of content you want to do in the future. Any words of wisdom to part, Dad?
No, that's it.
Thanks for stopping by.